Every single day, 1.9 billion servings of Coca-Cola are consumed around the world. But here is the secret most people do not know. Coca-Cola is not a beverage company. It is a real estate and financial dividend machine masquerading as a soda brand. If you have ever wondered how a company survived 2 world wars, the Great Depression, and multiple financial crises while paying an increasing dividend for more than 60 years, you are in the right place. Today, we are not talking about the formula locked in a vault. We are looking at the financial engineering that makes Warren Buffett hold over $9 billion in shares. Let's be completely transparent. Your time is valuable. In the next 10 minutes, I am going to show you exactly how the real Coca-Cola empire makes its money, the strategic real estate investments they hide in plain sight, and exactly how their franchise system creates an unstoppable cash machine. No fluff, no theories, just the raw financial data. Let us start with the hidden pain point that keeps most new investors awake at night. You look at the stock market, you see big brands, you buy them, and then a recession hits. Your portfolio bleeds. You lose your capital, and the dividends dry up. It feels like the entire system is built to take your money and leave you guessing when the next crash will happen. The traditional advice tells you to diversify and hold index funds. But the ultra-wealthy do not just hold index funds. They find companies that generate cash no matter what the economy is doing. The problem is that most people believe Coca-Cola makes all its money by selling plastic and glass bottles filled with sugar. That is the illusion. Here is the solution the insiders use. To beat the market, you must look at what a company owns, how it controls distribution, and how it avoids capital-intensive manufacturing while retaining massive brand equity. The solution is the franchise model combined with strategic real estate ownership. Let's break down the exact steps Coca-Cola used to build this empire. Step 1. The franchise separation. In the late 1800s, Asa Candler bought the rights to the Coca-Cola formula for just $2,300. It was a good deal, but the company was still small. Then, in 1899, Candler made one of the most brilliant business decisions in corporate history. He sold the bottling rights for only $1 to 2 lawyers from Chattanooga, Tennessee. At first glance, it looked like a terrible mistake. Why give away the bottling rights? But Candler understood the limitations of the manufacturing sector. Producing glass bottles and shipping heavy liquids across the country required enormous amounts of capital, labor, and machinery. By handing over the manufacturing and distribution to independent local bottlers, Candler transformed Coca-Cola from a heavy, capital-intensive manufacturing business into a lean, asset-light marketing and concentrate-producing powerhouse. Step 2. The concentrate business model. Today, Coca-Cola acts almost entirely as a syrup manufacturer. They produce the secret base, the concentrate, and the syrup, which they sell to their network of independent bottling partners. Let us look at the numbers. Coca-Cola sells the concentrate at a high margin, passing on the costs of production, local transportation, and bottling to the independent companies. This keeps Coca-Cola's operating margins exceptionally high, often hovering near 28 to 30%. Compare that to standard manufacturing companies that struggle to maintain single-digit margins. Because they do not own the massive bottling plants, the trucks, or the local warehouses, Coca-Cola requires very little physical capital to scale. When they want to enter a new market, they do not need to build factories. They simply ship the concentrate, saving billions in expansion costs. Step 3. The real estate empire. Now let's talk about the real magic trick, the real estate. As the bottling partners consolidated over the decades, Coca-Cola created a unique entity called Coca-Cola Refreshments, which was then spun off. But here is what they kept: the strategic real estate underlying key manufacturing and distribution facilities, along with the global real estate holdings of their major bottling partners in which they hold significant equity stakes. In addition to that, Coca-Cola owns some of the most valuable global real estate assets through its corporate headquarters and marketing centers in major financial hubs. But the true genius lies in the brand real estate. The physical logo and global presence are worth over $80 billion. When Warren Buffett bought shares in 1988, he didn't buy it for the sugary water. He bought the brand recognition and the moat. Step 4. The dividend king status. Coca-Cola is classified as a dividend king. This means they have increased their dividend payouts to shareholders for more than 50 consecutive years. In fact, it has been over 62 years of continuous dividend growth. How do they manage this in a world where consumer tastes shift constantly? The secret is pricing power. Because Coca-Cola has such a dominant position in global retail, they can increase the price of their products to match inflation without losing their massive customer base. When inflation rises, the cost of sugar and aluminum goes up, but Coca-Cola simply passes that cost on to the consumer. The revenue remains steady, and the cash flow continues to flow into the pockets of shareholders. Step 5. The marketing powerhouse. Coca-Cola spends billions every year on advertising. But this is not just to make you thirsty. It is a strategic mechanism to ensure that no competitor can ever take shelf space from them. By blanketing the market with advertisements, they create consumer retention that lasts for generations. When you walk into a grocery store, you do not search for a random soda. Your brain automatically recognizes the red color and the white font. Let us look at the financial data for a moment. In recent fiscal years, the company generated over $43 billion in annual revenue, resulting in more than $10 billion in free cash flow. This massive pile of cash is not reinvested into low-margin factories. It is used to buy back shares, reduce debt, and pay out generous dividends to shareholders. This brings us to the bonus for watching this video until the end. We are going to share an exclusive insight into how the smart money analyzes companies like Coca-Cola. Do not just look at the product that is being sold. Look at the balance sheet and check where the real value lies. Look for asset-light business models, strong pricing power, and consistent shareholder returns. If you found value in this deep financial breakdown, make sure to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss another deep dive into the corporate world. Thank you for watching, and we will see you in the next video.